Hello everyone, I am so glad you are here. Today we are going to talk about a topic that could literally save your startup from failure. Today we are going to talk about 9 most financial mistakes a startup founders make. So either you're a first time founder or you've already started your business, the chances are you've either made one of these mistakes or you're about to make these mistakes. In this video, you're going to learn the mistakes to be avoided in your business journey. Grab a coffee, take a note, and let's get started. Mistake number one, mixing personal and business finances. Now, this is a classic first time founder mistakes, which is they take up one account for their business as well as for their personal purposes. Well, you should never do that. The day you incorporate a company, you should have a separate business bank account, which would ensure that there is a transparency between what all expenses have been incurred for businesses and for personal purposes. This would help you a lot when you're scaling your business or you're talking to investors for the fundraising growth. So the fix for this is when the day you incorporate a business, you should open a separate business bank account. Okay, mistake number two, ignoring proper bookkeeping. I cannot stress this enough, right? I've already spoken in my previous videos as well that why bookkeeping is important. But for first time founders and for first time listeners, if you don't know where your money is going, you're literally flying a blind airplane. So you should keep a track of where your money is coming from, where your money is going out. Have seen a lot of founders take up a lot of subscriptions, renewals to automate the processes. But at the end of the month, you should know exactly where your money is coming from and where your money is going out, right? So to keep a track of it, you can use a simple software like Tally, Zoho Books, or even an Excel spreadsheet works literally. And if you have money in your bank account and if you have got cash flows, you should hire a virtual CFO who can help you streamline the processes, which can help you in a longer term rather than when you scale it up, you want to set up the processes and system in place. So number two mistakes which a founder should literally avoid is ignoring the bookkeeping. Mistake number three, overestimating revenue projections. Now, this mistakes, even a seasoned entrepreneurs who've got multiple exits still make this. They overestimate the revenue project. Surely, everyone wants to show a good picture, like in 3 months we are going to do 1 crores. In next 1 year we are going to achieve a revenue of 50 crores. Please understand, the sales cycle of business is not a linear sales cycle. There are going to be a good months, there are going to be a bad months, there are going to be a good season, there are going to be a bad season. So there are a couple of ways in which you can project your revenue. The methods are historical cash flow method, or second is a pipeline forecasting. There are tons of other as well, but for me these are the two personal favorites. Historical forecast method is a method where you understand your past data and on that basis you project it up. Suppose you are doing a projection for Q3 or of FY25. So then you will analyze what has happened in the previous quarters, in the previous years, and on that basis, you project it up. And in a pipeline forecasting, you discuss what are the sales pipeline or the customers which are going to get converted. Then you add those in a revenue forecast. So that's a pipeline forecast. Please understand, the forecasting of revenue is very critical from a growth perspective. I have literally worked with a couple of startups where they were expecting revenue to double down in every year, and they were heavily spending on marketing, infrastructure, employee cost, but at the end they were not being able to retain the user, which was ultimately leading to a cash loss month over month, and ultimately they had to shut the shop because the investors were not ready to fund as so. That's a request to everyone that have a realistic cash flow projections which would factor discounts like seasons, bad climates, and all the other conservative methods. So have a forecast which is conservative, good to have, and very optimistic as well. This brings me to the point number four, which is not building a financial buffer. See, as in startup, you're going to pivot a lot, which will require a capital, right? And it is important to have a certain capital in your bank account for a bad days or for a rainy days. So what is the financial buffer a startup or a business should build? In an ideal case scenario, a minimum of 6 months of your operating expenses should be parked separately either in a liquid funds or in a fixed deposit as a rainy day fund. In fact, do you know Oyo literally collapsed during an early stage because of financial conditions, but they have learned it in hard way. And I'm explaining it to you. Please ensure that the 6 months cash flows are always intact. Either it can be from an investor's money, it can be from your profits, or it can be from a bank debt. But ensure that 6 months of OPEX is lying separately as an rainy day funds. Now, let's talk about taxes, a topic which most of us love to hate but can't ignore. It is really important for a founder to be compliant with respect to your direct taxes or indirect taxes from day one, because if you're non-compliant, it could snowball into a lot of bigger penalties, interest liability, and not to forget the reputation which you're going to hamper with your investors, because ultimately they are going to do a due diligence on your books. So it is really important for you to be compliant with respect to all your taxes. It's a global phenomenon where it's been talked that cost of non-compliance is way higher than cost of compliances, and it is true in an Indian context as well. I remember working with an D2C startup during their early stage, and they were non-compliant from day one. They thought that it would be a very small interest or penalty. But after 6 months, they got a notice from the government seeking 1.5 lakhs as an interest and penalty. Now, this money could be used towards their marketing, towards the product development, or towards their research. But due to non-compliances, they had to spend to the government. Now, as a founder, it is really, really important to ensure that you're compliant from day one itself. Hire a good consultant, hire a good CFO who can help you, guide you with respect to what our taxes are there applicable for your businesses, and how can you be compliant with respect to all of this. This brings me to mistake number 6, which is overspending on non-essential. Let's be real, right? When you raise a first round of funding, the temptation to splurge the money is real. You want to get a new offices, you want to throw a party, you want to go for a team offsite, or you want to have a branded merchandise for your employees and everything. I have worked with 120 plus startups and businesses, and whenever they raise the funding, the first thing they do heavily invest in their office, which is building a fancy offices. Now, as a founder, you need to ask yourself whether this is going to really help your business to grow today, because capex which has been done today will not hurt your runway today, but after 6 months, it is definitely going to hurt your runway. Look at the example of WeWork, wherein they invested very heavy in their offices with respect to their parties, with respect to their dinners, networking, and everything. They had to scale everything down to survive from bankruptcy, right? So it is important to identify a good cost and a bad cost for a company. A good cost or a good expenses will help you grow your businesses. A bad cost will not lead to any growth on your businesses. Do not spend on non-essentials unless and until you've got a very buffer cash flows in your kitty. Mistake number 7, not tracking your unit economics. If I may ask you, do you know what is your customer acquisition cost? What is your profit per user? What is your average revenue per user? What is your burn rate? What is your runway? Do you have answer to this? If your answer is no, you are going on a road trip without a GPS or a navigation. So basically, you should know what is your North Star metrics, which you're going to track on a daily basis, on a weekly basis, on a monthly basis. Zomato realized during their early stage that they were spending too much of money on an marketing, on an getting up a customer. They realized that to grow their business in the right direction, they will have to cut down on marketing and increase the average spending from the same customer. That's how you grow your businesses. Identify your North Star metrics, be it your profitability, be it your income, be it your customer acquisition. It can be anything, and focus on those metrics. Mistake number 8, avoiding fundraising till it's too late. I know fundraising is a full-time job and it requires substantial amount of energy and time, and it's very difficult to grow your businesses as well as focus on a fundraising. But please note, you cannot run your businesses without a fund. So it is really important to plan your fundraise well in advance. As per survey conducted, usually takes 3 months to 6 months or up to 9 months to close the fundraising deal entirely. So it is really important to network with the investors or start speaking the investors when you feel that the runway is left of 9 months or 12 months. During an early stage of Paytm, they had raised multiple rounds of fundraising before even they have launched their businesses. Now, this helped them to focus on growing or expanding their businesses, because when you're short of funds, you do not want to accept a deal which is not favorable to your terms and conditions. So, focus on a right fundraising plan and strategies, network with the investors, because in a long time it is definitely going to pay you off. Mistake number 9, leaving due diligence prep until the last moment. I know as a founder, you're focused on growing your businesses, hiring team, investments on capex and whatnot. But please note, the investors are going to give your money once they are satisfied with your due diligence. So it is really important for you to keep your financial records, books, tax records, and everything up to date and are investor ready or a due diligence ready. I remember working with one startup, a SaaS startup. They were looking to raise a seed funding from an investors, and term sheets and everything has been closed. But when the due diligence started, they were literally struggling, and investors coughed the term sheets from them, and they had to scout for the new investors, and it literally took more 6 months for them to close that deal, and they were on the verge of closure of their startup. So it is really important that you are prepared from an due diligence perspective from day one itself. It is not just about the investors, it is about how you're running the businesses and how clean your records are. So please be updated with your books, tax records, and everything from a due diligence perspective until it's too late. All right, that's a wrap. These are the 9 financial mistakes that are going to make or break a startup. If you like this video, share it with your friend or someone who may need it. Mention down in a comment box below which all financial mistakes you made during your early stage of businesses, and would love to understand what all challenges you faced. And hey, mention down in the comment box below which all mistakes you made during your early stage businesses and how you overcome that. Until next time, stay sharp, stay savvy, build your dream. Thank you. Have a good day.